after they were 62. Let's say they were 62 years old and then they met somebody and got remarried. That's fine, but then they would have to reapply for a new HECM loan and put it in their name and their new spouse's name.
So let's pretend for a minute, and this is almost a dangerous thing to do, but we're not that far away from the housing crash that it is an intelligent thing to do. Let's say that the market slowed down and we didn't see the appreciation as fast. Is there anything that's going to cover them or protect them on that selling end, or at the time of their passing, what's going to happen to the family and the balance? Because I know that's the fear, is that that they've really just played a game with themselves to have no payment, and there's not going to be any equity left.
Right. Well, back in 2010, 2008, 9, and 10 was the first time that we've had, an economic crash in the real estate market. But let's say, for instance, it does happen. Let's say the values just plummet again. Let's hope that doesn't happen. But let's say they plummet, and both spouses are still alive. Well, it doesn't matter. The house could be worth. They bought it for $300,000. It's worth $100,000. Doesn't matter, because the FHA insurance is going to kick in whenever they exit the property. What I mean by exiting, whether pass or move out. So what would happen is they could stay in that house as long as they live, as long as they make the taxes and pay the taxes and the insurance. But let's say both spouse, husband and wife, both pass away. Now, their children inherit the property. What would happen at that point? Let's make it easy. Let's say the value is $100,000, and remember they bought it for They bought it for $300,000, and let's say the value is $100,000, and now the balance is way over $150,000. Let's say it's $200,000 is the balance. So what would happen is, let's say one of their children want to buy the house. That was mom and dad's house, and we had a lot of memories there. We don't want to see that house go. It's a really nice home. So what would happen is they would let the bank know, look, I'm a survivor of the people that had passed, and we want to buy the house. Well, the value is $100,000. Balance is $200,000. The way the FHA loan works is the insurance is going to pay the difference. So they would only be responsible for 95% of the value, or the balance, whichever is less. So in this case, the value is $100,000. They pay $95,000 for the home. There's a balance of $200,000. The FHA insurance that their parents paid for, their mother and father paid for, is going to pay the bank the difference, so the bank doesn't lose any money. That's why it's a safe product.
That's really a key feature. That's I trying to educate and share with people the advantages of the reverse mortgage, especially to our senior population. Well, I mean, you have to be 62 to take advantage of this, but I know it got kind of a bad rap, and this is something I wasn't completely understanding myself, and that's what that FHA insurance, that's what makes this product so valuable. I mean, it really does protect them. It's not only working for you as the economy is growing, but let's just say it didn't, you're still protected.
Correct. So let's do it. Let's see what would happen on the other side. So let's say the value is still there. Let's say the value is now, they bought the home for $300,000. Let's say the value is $400,000. Mom and dad passed away. The balance is $200,000, but the value is $400,000. Now they could come in and they could buy the house and and refinance it and put it into their name, and then they would pay the $200,000 and put it into their name. Of course, they would have to put 5% down because that's the requirement. So, now let's say, for instance, they're like, no, we don't want the house. We don't want the house. we just want to sell it. We want to take the proceeds and divide it amongst the survivors, and so they do that. So the house is worth 400. Balance is 200. So they put it on the market. They pay for it. They're going to take the proceeds and give. And once whatever after it's all said and done, the mortgage is paid off and the real estate fees and everything else is done and over with. Say they walk away with 175. They can turn around and divide that 175 amongst the relatives, amongst whoever was included.
Yeah.
And, let's say, for instance, again, I needed to say this also. Let's say, for instance, let's go back to the original one that I had said where the value was 100,000 and the balance was 200,000. Let's say that the child wanted to just walk away. Say, you know what? We don't want the property. They're upside down on the house. It really doesn't mean that much to us. They can give it back to the bank and there's no problem. There's nothing, there's no issues at all.
They don't owe that difference, even on the interest?
Don't owe the difference because the FHA insurance is going to cover the difference. And they weren't on the loan, so they're not going to be responsible for it. But they have the choice. Basically, they have the choice of refinancing it, putting it into their name. They have a choice of selling the house and keeping the proceeds or giving it back to the bank. Now, it would be kind of not a smart thing to do, giving it back to the bank when there's $200,000 worth of equity sitting there. See what I'm saying?
I agree, yeah.
And so, they would, if they didn't want the house, they could turn around and put the house on the market and keep the proceeds.
They could call me.
It's a win-win situation for everybody. It helps the parents to be able to live in their senior years without the burden of having a mortgage payment, and to be able to use their retirement income, whether it's just Social Security or Social Security and a pension, to do whatever they want, to maybe travel or just to live life and just be easy.
Well, and that's I know we're probably getting close to the end. So I just want to, I know this isn't the only loan you do. I just have a personal interest in helping to educate people about how to use this. But do you have other products that that our senior demographic finds attractive in purchasing their second home?
Yeah. For instance, like let's say you live just outside. Let's say you live out in Mayaca City, or you live east of the interstate, pretty much east of the interstate. That is called it's a USDA area. So what would happen with a USDA area, if you have a 640 plus credit score, you can get 100% financing on property that is east of the interstate, which is pretty good. So if you had limited funds and you didn't have all that money to put down on a house, you still have that product. And that's also not just for seniors, but it's for anybody who would qualify. And then we have the FHA loan, which is 3.5% down. This is a product that everybody else has too. We all have the same product. Conventional loans with either 3% or 5% or 10 or 20% down. And we also have the renovation loans. So if somebody let's say they find the perfect home, and they're like, you know what, that this is exactly what we're looking for, but it needs a new roof. It needs some remodeling. We have what's called a home style or a 203K. A 203K is an FHA loan, and a home style product is a Fannie Mae loan, and you can renovate the home and have it fixed up and ready for you to when you move in. So.
Well, that's great to know. And I know we're down to the last few minutes. Is there anything special that you want to make sure that the audience takes away with them today?
Well, just know that no matter what mortgage professional that you go through, most of us that are down here in this area, we are well seasoned, and you're going to be dealing with individuals who take pride in their job, and our goal is to make sure that you're happy. Now, there are some that are more seasoned than others. So one thing that I wanted to mention too is that now I've worked at the banks, and I've worked for myself, and a lot of times people don't realize this, but majority of the people the loan officers that work at the banks they're only registered mortgage originators. They're not licensed mortgage originators because they're working under the business license or the bank's license. Where myself and all my staff and my processors, we are all licensed professionals. We had to take the class, we had to take the course, we had to pass the test. Where when you work for a bank, you just have to register with the nationwide mortgage licensing system, where I'm licensed. I'm actually licensed to do loans in over 41 states, but I can, I'm so busy, I only have time to do loans in Florida. So,
yeah, that's a long arm.
yeah.
So, well, I appreciate this. We have been talking with Joe Morningstar from Morningstar Mortgage here in Sarasota County. And we want to thank you. If someone wanted to reach you, how would they be able to find you, Joe?
Well, they could just Google Morningstar Mortgage, Port Charlotte, Florida, and it'll pop up. I have the highest rated down here in Northport, Port Charlotte, and in Inglewood. And Punta Gorda. I have the highest Google ratings down here. But they would just Google my company, or you could call the phone number. It's a very easy number to remember. It's a 941-426-STAR. So 941-426-STAR. So think of Morningstar Mortgage. All you have to really remember is 426-STAR if you live in the 941 area code.
Well, thank you, Joe Morningstar. And thank you, audience, for listening. If you have any questions or comments, please contact me at maggierosemarch.com or realestatehotwired@gmail.com.
This has been Real Estate Hotwired with Maggie Rose March.